Hey, good evening, options traders. This is a 5 to 7 minute video that is really aimed at you, the options trader, or the trader who wants to leverage options to create a second revenue stream. First, I want to start off by asking you just a couple of really quick questions. This whole presentation is only comprised of 4 slides, but I think it has some really interesting information that you're not going to hear elsewhere. Now, the chances are you've tried trading options on your own and you've lost money, because most option traders do lose money. You may have subscribed to an options service and took their trade recommendations and you still lost money. Now, the worst is that you hired an expensive mentor and paid his fee, and the trade recommendations that you subsequently took based on this mentorship, they cost you a fortune. And if you have, this short video is really going to be very helpful to you. Now, I'm going to skip this next slide and just tell you that everything that you need to know about trading options can be learned at trading right here at Trading Options for Dummies. You can get a fundamental understanding of options from this book, and you don't need to pay a dime for any kind of expensive mentorship. That is, I believe, one of the biggest fruitless endeavors available, and it's the best way to throw your money out the window. Now, I want to add, that's why we don't offer it. We don't offer you any kind of options mentorship program because I don't believe in them. And the reason I don't believe in them is this is all you need to know. In fact, this is more than you need to know. Now, let me show you 3 positions we closed out this week. And this is the week of October 8th. We closed on a bull call spread on Expedia. It was the November 17, 150, 140 call spread. We paid $4.50 for the spread. We closed it. We purchased it for $4.50. We got $6.15 when we closed it. That's $165 per spread, and that was a 37% profit. Now, we would have made more money if we held the spread into November, because as you get closer and closer to options expiration on a spread, the amount of money you make in a winning position goes up. But this is such a shaky market and such a difficult market to spread that Expedia went to $149.50, 50 cents below our $150 target price. So I recommended to close it. It still had a lot of time premium remaining. That's why we didn't make closer to 100% or even more on the spread. Remember, we risked $450 to make $550. Now on Abbott Laboratories, I don't recommend to buy many calls or buy puts, but I just really liked Abbott. I recommend to buy the November 17 $50 call. We paid $2.25 for the call. We closed and we got $4.45 for the call. That's $2.20. That's $220 per contract. That's a 97% profit. Now what I do is every evening I look at the ticker. I have 2 services that provide me with updated information about any stocks or any options. I checked the ticker before I went to bed, and I saw that the FDA had approved Abbott's glucose monitoring system. I looked at the pre-market movement on Abbott. It was already up in the evening. I recommended to close the spread first thing in the morning. Remember, when a stock gaps up, volatility is going to skyrocket, and the price of the option is going to go way up. We closed and really milked this position for a major amount of money. Again, another just call that I bought on a position I really felt strongly about was Taiwan Semiconductor. We bought it. It was the October 20, so we didn't have that much time on it. We bought the $37 call for $1, and we sold it for $1.65. That's $165. I'm sorry, that's $65 per contract, a profit or 65 cents. Now, this is a tough market to trade options. And we have closed out so far in the portfolio 95 positions in which about 65% are winners and 35% are losers. That is way above industry standard. Industry standard is 30% winners and 70% losers. We are astronomically higher than that. I take every position in the options portfolio in my cash portfolio that is in the options alert. And if anyone wants to see my cash account, they're more than happy to see it. I have an account with TD Ameritrade, and I trade with Thinkorswim. Now, like I said, we do not have an options alert portfolio. I'm sorry, an options alert mentorship. Now, we don't offer you an expensive mentorship program because as a member, we give members only webinars, and I'm going to show you how I trade options. It's supposed to be for free. I'm not going to charge you any money for that because I don't believe that you should pay anything. The actual logistics and technical analysis that I use is very, very straightforward, except it's very time-consuming. If you want to spend the time, I'm going to show you what I do every night. I just scroll through a huge number of stocks. I have 2 services. I have Options Monster, and I have Benzinga Pro, and I go through all of those options trades, and I look for what I consider to be the pick of the litter, so to speak, and those are the ones we take. And like I said, we do not use complex option setups. The more legs in an option spread or option setup, the more bid asks you have to deal with, the more slippage you're going to get, the more difficult. I don't trade butterflies. I don't trade iron condors. I know there are specific times and places for these. I don't trade straddles. I don't trade strangles. I always have a really excellent idea of the direction the trade is going to go. It's simply a matter of picking the most profitable spread, or occasionally simply the most profitable call or the most profitable put. I think we can use to leverage the position. We want to risk as little as possible to make as much as possible. And I trade mostly vertical spreads. I'm going to teach you whether to buy a call spread or a put spread. Again, I take all the trades in my cash account with Thinkorswim, and anybody is welcome to see that portfolio. And what I do is, and what very few options portfolio managers or options gurus do, is they recommend and they throw out to you a trade, and a trade. So you're out there with a couple of trades. We hold a diversified portfolio of options. And that's very, very important in a volatile market. You don't want to have 2 or 3 options positions out there. If they're all in tech and tech tanks, you're going to be in big trouble. What we do is we have options positions in tech, biotech, pharmaceutical, in the retail sector, in energy. We have a very, very diversified portfolio of options, so that if one sector lags, the other one doesn't. And usually in a time where the market really collapses, we usually have a couple of options positions that go up. And I'll just throw you a quick tip. When you have a diversified portfolio of options, I always look to close a couple of positions into major market strength. Those positions are either close to my profit target or right on it. And then I always set up 2 or 3 really good options positions I want to look for to get on a big pullback, say at a 5% market pullback, so that I can use a pullback to acquire positions that have a great probability of moving up once the market just shows a little bit of strength. I have 3 of those positions sitting right now in the options portfolio, one triggered on Friday, and two of them are still out there. Now, I don't think I'm going to get the one on Netflix because Netflix is rocking too hard and will not give me the pullback. But the other position, I think, will eventually click. It's very close. Now, what I want to do is I want to show you a stock and show you some of the technicals. I'm going to show you CVS. Now, CVS we entered right here. And the technical analysis is really important. I'm not going to go into it right now because that's really not the purpose of this. But CVS was really in a great position for a vertical spread, a bullish vertical spread. And you can see this blue line is the high that CVS made. Now, we were looking for 85 as our target price. It was very close. It was only a buck off a $10 spread. But then what happened to CVS? Well, Amazon made its first announcement right here that it was going to enter the pharmaceutical space. So, of course, it tanked CVS. Now, this is where CVS broke support, but you can see it didn't break all support. It did not break this critical area of support right here, and this happens to be the value area high of the chart. So we held, and you can see what happened. CVS rebounded. Then Amazon announced again, pounded the table, and said they're definitely going into the pharmaceutical space, came out strongly, and again, this is where Amazon sits today. I'm sorry, where CVS sits today, right on top of major support. Now, if it breaks this area of support, we're going to have to close the position. What I'm hoping is that CVS will hold here and will come back. Now, this is where not only the technicals come into play, but also the fundamentals. You know, Amazon is 2 years at minimum away from entering the pharmaceutical space. Now, the pharmaceutical industry is the first time that Amazon has delved into a government-regulated industry. The reimbursement that Amazon will receive for every pharmaceutical or every prescription that they dispense is going to be based on the patient's insurance. There are 1,000 different variables in addition. But they're going to have essentially millions of patients on file, all with their insurance, which is constantly being updated. They're going to get 100 million complaints. If you've ever gone to your local pharmacy, the major chains are CVS and Walgreens. You know that Rite Aid is heading down the drain. Those are really the two remaining. Most of the mom and pop pharmacies are gone. And the reason is because the pricing leverage that CVS and Walgreens gets is really outstanding. But going there is a headache. You know, I'm on a couple of pharmaceutical prescriptions for my stomach, and every time I go to the pharmacy, it makes my stomach worse. There's always a line. There are constant mistakes. The pricing errors are just incredibly bad. This is a space, I think, if they get into, they're going to really, it's going to be the first banana peel that Jeff Bezos ever slipped on, and he's a brilliant guy, but I do not see him successfully negotiating this space via an online mechanism. Simply the prospect of hundreds of thousands of patients faxing in prescriptions in and of itself is a logistical nightmare. They're going to be inundated with phony prescriptions. It's really going to be a major headache. And I think they made a mistake. So I would like to hold on to CVS. I just hope it doesn't break support. What's the investors that are selling CVS right now are the weak hands. There are those that are really up a lot on CVS. They've made a significant amount of profit, so they're willing to sell out of concern that they're going to lose all of their profit. but their selling here still provides them with a significant amount of profit. And then just amateur investors who are just running at the first sign of Amazon stating and then reaffirming that they're going to go into this space. They may wind up never doing it. So I just wanted to show you how difficult sometimes it is to create an option spread. I mean, CVS was right there and just about to break to 85, close us out, and now we're sitting at a loss on the CVS spread. We had a very, very nice profit, but we're going to hold. These are the kind of charts I look at. I'm not going to really go into much about them because it's not the purpose here, but it's simply to show you that both technicals and fundamentals play a very, very important role in how we buy options. Again, a lot of the technicals, I look at the money flow, I look at big investors creating large options positions, and in order to do that, I need Benzinga Pro and I need Options Monster. They're both extremely helpful, but they're very time-consuming. And like I said, the manner in which I create positions, I am going to teach you if you are a member of our Options Alert newsletter. Now, sometimes I'll publish a newsletter 3 times in one day. I mean, if the market's really moving and we've got positions that are flying, we may close out 2 or 3 in a day. We may move into 2 or 3 positions in a day. Other times, if the market's really slow and our positions are just sitting, there may not be an Options Alert newsletter for 3 or 4 days. Now, I think I've sent out 130 newsletters, 130 alerts so far this year. We will probably easily eclipse 200 newsletters in 2017. So I send them out often. I give you the exact entry price, the exact exit price, and on the newsletter you will see that I enter every position. When I recommend the position, it's open, and I take the closed position in which I'm still sitting in the position. So I buy and sell options exactly the way everyone else in the newsletter is doing, and that's extremely rare. And I can tell you without any equivocation, I am up a tidy sum so far in 2017. We have made really, really nice money. So I hope to see you in the news alert. As part of this, we're offering the first month for $49. I think it's a huge bargain, given the fact that I spend so much time every evening really doing a tremendous amount of due diligence. I want to capture every single advantageous options trade for me and my money, and I also want to get them for you in this newsletter. So listen, have a great evening. I hope you picked up some tips. Don't pay anyone for an expensive mentorship. They're going to teach you everything you can learn in trading options for dummies, but they're not going to create lucrative options positions for you. And then when you trade their system, you're going to get killed. Spend a little bit of money, and you're going to see that you can make nice money. Have a wonderful evening.